Start with gold. Gold is finally doing what it's supposed to do in times like this.
And the volatility isn't going to go away. I think, gold is really starting to look good on a number of fronts. I mean, we've seen central banks now move to the sidelines. The hawkish talk is ending, or it's already ended. And gold has broken out technically. We're above the 200-day moving average today, best level in a number of months. And gold has quietly risen about 10% since August. And you can't point to many things that have done that well in that time.
Why do you think it took so? I mean, we've been on the rise for the past couple of months, but even we had some tumultuous times in the other parts of the year. And I'd always look at gold on a day where everything was going haywire and thought, why isn't it doing what it used to do all the time? It only seems to be getting back to its old act now.
Yeah, I think that gold needs to capture the market's imagination again. I think there were so many gold bulls, so many retail traders invested in gold for years, and they just watched it languish while other things, and it might have been Bitcoin, which is, essentially dead now. That speculative money might look for a new home and find gold. And secondly, we're moving into a period of very good seasonal strength for gold. The first quarter of the year, and especially the first 2 months of the year, are traditionally the best time of year for gold. And seasonals are one of those things that shouldn't really work in an efficient market, yet they do year in, year out. And January, February in gold is the strongest seasonal pattern you can find in almost any market.
All right, I did a little thing on the Canadian dollar there, but now I have you here. I want to get your perspective. We're dancing around 74 cents. It seems that in terms of central banks, both ours and in the United States, definitely a change of tone in the past couple of weeks. It's going to be a different 2019 in the early going than we thought it was going to be in terms of borrowing costs. Yeah,
I mean, the central banks are in a tough spot right now. They've hiked, they've been hawkish, and you have data that's been pretty good. We had a secondary Canadian employment report came out today. It was strong again. And they're looking at this data and saying this is what's supposed to guide us, and markets are saying something completely different. And you need to get some kind of resolution to that, because if the data keeps up like it is right now, I mean, the Canadian dollar is going to bounce back, and the Bank of Canada will be back hiking, and the Fed will be back hiking. And then markets would be completely wrong. But if you look at forward-looking things, CapEx, some of it's down. If you look at commodities, which are extremely forward-looking, they're really at the pain threshold here for the Canadian dollar.
Now, when I take a look at that one-year chart we were just showing the audience of the Canadian dollar, earlier in the year when we were grinding lower and lower, a lot of that was saying, well, we got the NAFTA negotiations hanging over our head. That's a lot of uncertainty. But then you get to the fall and we square things away and we just keep on grinding lower. Is it a bit troubling to try to figure out what happened there? Because a lot of the conversation we had this year is like, once we get NAFTA behind us, maybe the Canadian dollar rises to 76, 77. We're just not there.
Yeah, I mean, it caught everybody really by surprise at how tough it's been. It's been a tough year because a lot of these trade concerns with China were there all year as well. And then finally, things just started to come together and the market rolled over. And we're at this point here now where there's a risk of an overshoot, if we're not there already. I mean, if you look back to 2016, we had a very similar setup when oil was crumbling and the Canadian dollar was crumbling. It went all the way down to 68 cents. And that's still a lot of pain from here. And it happened very fast, and then it came back very quickly. And I think we could be starting into something very similar here where there's a lot of people throwing in the towel, but we might not be done yet, especially if we get into the low 40s or even worse in oil.
All right, and the other side of that equation, obviously, when we talk about the Canadian dollar, is the U.S. dollar. Let's take a look, because yesterday was a very big day. The investment eyes of the world were on the Federal Reserve, and it didn't seem that Jerome Powell was willing to completely go full tilt dove. A little bit softer, but not to the degree that a lot of people thought.
I mean, a lot has been said on the Fed already, and you would have expected. There's no inflation, right? And we've been saying this for years. Where's the inflation? You have a goal about inflation, and you're not at 2%. You haven't been at 2% for 7 years. So let inflation get there. Let it happen. And yet they're leaning against it. Now, one thing that really surprised me from Powell was he brushed off trade concerns. I mean, he was asked about it and he dismissed it almost outright, except to say, businesses might adjust. But for me, I think central bankers and markets and almost everyone is far too confident in these models that show there's not that much flow through from what's happening on trade, whereas we don't know what's happening in inventories. I think a lot of companies are concerned about what's happening in China and are building inventories, and that may have boosted growth this year, and they may still be continuing to build inventories. And then if the tariffs hit, or even if they don't hit, they'll dig into those inventories and growth will be much slower than we thought. And I think that's one of the messages we're seeing now. And I think we have to watch China very closely to see if those orders are coming through.